Greetings and welcome to Module 18. We're going to get into some more costing analysis. We're going to be talking about product and period costs. We're also going to be isolating and summarizing costs as materials, labor, and overhead. Where often materials is actual, labor is actual, but overhead is going to be a factor that we get to calculate. So let's go have some fun. Let's take a look at what we're doing. And we're going to be talking about operations, job costing, and process costing. Process is more the mass produced, where jobs are a little more individualized. So the first objective, describe inventory requirements and measurement issues in different types of organizations. So we've got three types of organizations: service, we don't sell products with service folks, but performing work, an attorney, an accountant, performing work for others. Then we have the merchandisers, the retailers and the wholesalers, buys and sells goods, but normally doesn't make it themselves. And thirdly, we have manufacturing. They take raw materials, process into finished products with an interim stage called WIP, or work in process. So looking at a summary, service inventory, the asset, there's more of supplies for services. They don't actually store goods, where a merchandiser has a merchandise and has supplies. And the manufacturer not only has supplies and has some office supplies and manufacturing supplies, but also has the raw materials, the work in process, and the finished goods. And the finished goods inventory is what ends up being transferred to cost of goods sold at our costs. One tip here is costs can include materials, can include labor, and can include overhead as part of the costing of what we have stock. So you say inventory, that's an asset. I mean, I've got labor as an asset. I've got overhead as an asset. And the short answer is yes. So what's the role of product costs? We'll finish off this segment on the three types. Basically, we're analyzing costs to see if what we're selling is profitable. We're going to evaluate profitability and performance. If we do not have effective or accurate cost information, our pricing might be out of whack. We might be costing goods too high. If our costs that we think are higher and our competitors are doing it for less, they're going to get the business. We're going to lose it. And we say, well, we're going to lose money if we have to sell this stuff. And if our costs are inaccurate, we may not actually be losing money at all. And then we have to make decisions for our product mix. And then we might draw wrong conclusions. We're going to merge learning objective 2 as part of this. And we're going to have that structure of costing. And we're going to divide it starting out with product costs versus period costs. And product costs are any of the costs necessary to get the products ready to sell, associated with the products. And even on a warehouse or wholesaler or retailer, product costs include shipping. That's what we got to add to the inventory valuation. And we include shipping costs as part of that, because when we sell it, we're going to reduce the shipping cost, or the inventory that's associated that includes shipping costs. Well, that'll become all part of cost of goods sold. The period costs, the things that happen during a time period, are all the other costs that are not necessarily directly related to the product costs. So out of process of elimination. So if we're looking down, we also have, I mentioned earlier, labor, materials, and overhead. Now let me talk about direct materials versus indirect, and direct labor versus indirect labor, and then the manufacturing overhead. So direct materials is the cost of the primary raw materials. If we're making cars, we're going to have to get sheet metal. We're going to have to get plastic. We're going to have to get pieces and parts. We might have to get batteries. We might have to get tires. The labor is the direct labor, is the labor associated with assembling the cars on the assembly line, putting the things together, directly related to the manufacturer. Now, you might have ancillary labor that is not included here, the labor of managers and supervisors that aren't assigned to the vehicles themselves, security guards. We might have labor outside. And manufacturing overhead, as I mentioned earlier, that is an allocation, and we usually base it on something like labor hours, or maybe pounds or tons of materials, or some other factor that we estimate based on a total for the year, and then we get total per hour, total per pound, total per whatever criteria we're using. And we'll see how that works when we go to calculate an overhead rate, and then assign that. So all these costs, direct materials, direct labor, and manufacturing overhead, go into the work in process inventory. Then the work in process is finished, goes into finished goods, and when we sell the stuff, we move it over to cost of goods. And as it mentions here, it's expensed when sold. Our period costs are a bunch of other things that are not directly related to the product or can't be assigned to the product itself. So you look at that and say, oh, we got depreciation on showroom or depreciation on machines, expired insurance, president's salary, showroom maintenance, non-factory office utilities, non-factory office rent. Now you say, wait a minute, I can have factory property taxes. I can have factory machines. Those are all associated with factory production. But the outside stuff is something that we cannot really allocate directly to what we're producing. So it becomes period costs. And we also, it falls under SG&A, selling, general, administrative is the cost factors that go with that. And then we have the big question mark. We had materials, we had labor, and that actually makes sense. It took 5 hours to do this, make this item, 3 hours to do this part. It took this much in materials to make this. But how do we allocate this big clump of manufacturing overhead? Depreciation on the equipment. And we started talking about other things that are associated with the environment. And how do we go ahead and tackle that? So if we're going in and we're taking a look at the overhead, we have to take a budget for that on a gross basis, on an annual basis. So we're going to look at that and say, okay, what is a cost driver we want to use to assign overhead costs? And for simplicity, we probably will be assigning only one cost driver. Might be labor hours, might be material pounds, might be units of some other production hours, machinery equipment hours, whatever it might be. There is something we'll talk about called ABC, activity-based costing, where we have multiple overhead factors, which we'll introduce a little bit later in this module. But right now, we're going to look at a single cost driver, and we're going to calculate an overhead based on that particular driver. Now, it's almost never going to be an exact science. We said, well, we spent $100,000 in overhead last year, and we had 100,000 hours of labor hours to make what we did. So that's about $1 an hour. So what happens when we make 120,000 or use 120,000 hours? Well, we're going to allocate $120,000 instead of 100,000. And our actual overhead costs might not be 120, might not even be 110 or 100, it might be 105. So we will have over allocated. Again, overhead is an estimate, and we have to determine what says here, predetermined manufacturing overrate. So let's look at how we calculate that. So we're going to predict the total direct labor hours in this case, or predicted total machine hours for the year. We're also going to predict the total manufacturing cost for the year. These are projections. This is the expectation. Again, it is an estimate, so it may or may not be real close to what we're doing, but it's the best shot we have. So the predetermined overhead rate uses predicted amounts as actual amounts are unknown. So we don't really know how much we're going to be spending in the next year, but we can estimate it. So now we're going to go through, and once we come up with a factor, we're going to apply that overhead as we produce things. So we assign it to the work in process inventory. We'll take the actual direct labor hours incurred in a period of time and multiply it by this overhead rate that we calculated based on future expectations. So again, if we had $1 an hour, we'd multiply the actual. We did 20 hours this week. We did 70 hours next week. We'll multiply that by $1 an hour, and that will be the overhead that's added to the direct labor, which if it was 20 hours, we're going to have whatever labor rates we have. Materials, if it was so many pounds of this and so many parts and pieces of that. So materials, direct labor, and this estimate of overhead, where we go. So predetermined overhead rate, here's an example. We started with 128,000 expected of overhead next year, with 40,000 direct labor hours total projected for next year. That comes to $3.20 a direct labor hour. When we multiply that out, well, we did 2,200 in hours times 320 an hour. That's a per direct labor hour, total of 7,000 per direct labor hours where we're going. And again, this may vary because actual and projected are likely to be different numbers. So then we'll go in, and the impact of technology. We've actually talked a little bit about this before. As we get into more equipment being purchased, more automation, we have our overhead and our fixed cost rising, but we might be saving on labor. We have less labor hours, and if you have less employees, you want to have the machines doing the job, and you don't have the employees that you have to worry about. So these costs are shifting from labor to overhead. Materials are still going to be similar, but the labor is being reduced, overhead's increasing. So direct labor hours may no longer be a good cost driver. And as I mentioned earlier, we have multiple cost drivers with something called ABC, or activity-based costing. So that's the first elements of this particular module, and we will continue onward and upward, and look forward to seeing you shortly.